Hello, it's Bob Steele. In this lecture, we'll be looking at Chapter 9, Financial Planning and Analysis, the Master Budget. So, objective number 1, explain the relationship between financial planning and analysis and the Master Budget. So, the Master Budget fits into the idea of financial planning and analysis system. So, we're going to have a system for the financial planning and analysis. The system helps managers assess the company's future and know if they are reaching their performance goals. So that's our objective of the entire system. A complete financial plan and analysis system includes subsystems for planning, measuring and recording results, and evaluating our performance. So that's going to be the system of every well-rounded plan. We're going to first plan what we want to do, then we're going to measure the results of what we did do, and then we're going to evaluate the performance. And of course, the budget is the first part of that. We're doing the plan so that we can then measure and compare results to the plan that we had created. So the planning component of the financial plan and analysis system is called the Master Budget. It is intended to help ensure that plans are consistent and yield a result that makes sense for the organization. Objective number 2, list and explain 5 purposes of budgeting. Okay, so the budget is a detailed plan expressed in quantitative terms that specify how resources will be acquired and used during a specific period of time. So the advantage of the budget in that case is, of course, to have quantitative terms, measurable terms that we can then compare results against. And so our objectives are to plan. We want to facilitate communication and coordination through the budgeting process. We want to allocate resources, so that's going to be part of the planning process. And controlling profit and operations, we want to evaluate performance and providing incentives. Okay, so when we look at the budget, we're going to have the master budget that's going to be covering all phases of a company. In order to come up with the master budget, we're going to have more detailed budgets. Those detailed budgets will include a sales budget, a detailed production budget of the stuff we're going to make, and a detailed materials budget, the stuff that we're going to purchase. Okay, so we have the types of budgets. When we think of a budget, we have the income statement, which of course is budgeting a time period, a time frame, a beginning and an end. So that may be a year, that may be a month. So we're budgeting how well we will do in terms of performance during that period. We have the statement of cash flows, because the income statement is on the accrual basis and not a cash basis. We also want to budget our cash flows and see how the cash flows are doing for that same time period. And then we have the balance sheet, which is basically going to tell us where we stand at the end of a certain time period. So remember, the balance sheet is as of a point in time. The income statement is a time frame. So at the end of the 1 month or the end of the 1 year, where will our financial standing be? Meaning, what will our assets, liabilities, and owner's equity be at that point in time? So budgeted financial statements. We could have a few different types of budgets. So we could have long-range budgets. We could have a capital budget with acquisitions that normally cover several years. So if we have a long-term purchase in mind, we may have a capital budget for that reason, a long-term budget. We may have a financial budget for financial resources. How are we going to finance the business, including, are we going to sell more stocks? Are we going to issue more stocks, take out a loan, or what kind of long-term budgeting for financial needs? We could also have a continuous or a rolling budget. This budget is usually a 12-month budget that rolls forward 1 month as the current month is completed. So the idea of this is that we're going to budget a year out into the future. And as soon as 1 month is done, we have 1 more month of data. Therefore, we're going to revise our budget to budget 1 year out into the future again. So that any given point in time, we always have a budget that is extended into the future 1 year at any given point in time, because we're going to revise the budget every month. Alright, objective 3, describe the similarities and differences in operating budgets prepared by manufacturers, service industry firms, and merchandisers, as well as nonprofits. Okay, so this is kind of a long picture. We're going to basically talk about a manufacturing company because it's going to be the most complete type of budget in many ways, and then you can see how we would trim back this to fit a purchasing company and a service industry. So they're all going to have budget, and so will a nonprofit. Nonprofits will have the budget and governments should have a budget. So this is the process in the manufacturing. We're going to start with sales. And of course, the reason we start with sales is because in order to do anything else, first we need to know how much sales is going to be in order to know how much goods we need to have on hand. So we need to know how much product we need to make. In order to do that, we have to budget for sales. Then once we know how much we're going to sell, we can come up with a production budget, meaning how much of the things that we sell do we have to then produce. And in order to come up with a production budget, we're also going to have to think about, well, do we want to have a cushion, or how much of a cushion do we want to have at the end of the year? Because this budgeted sales is just an estimate. So we might want to have a cushion in case sales are greater than our budget, and then we don't want to run out of inventory. So we might have a cushion at the end. Therefore, we're going to have to budget what should that ending inventory be in our production budget. Once we know how much we're going to produce, if we make things, then we have to budget how much stuff is going to be needed in order to make those things. And we know what goes into the production. It includes direct materials, direct labor, manufacturing overhead. So when we talk about direct materials, if we're talking about like guitars or something, now that we know how much we need to make, we need to know how much material we need to buy. And in order to know how much material we need to buy, we once again might want to have a cushion as of the ending inventory in materials, so that we don't run out of materials in our production process. We're also going to need to know the labor and the overhead, which is everything else that it goes in that bucket that we're going to produce into the product. So once we know what these three items will be, then we can think about what the cash flow will be in order to provide for those items. And once we have that, then we can also do our period costs. The period costs will be the selling and administrative costs. And these will probably be easier for the most part because often those are going to be similar in nature from the prior period. And then we're going to have the budget. Then we can create from that point the budgeted income statement, the budgeted balance sheet, the income statement once again being the period of time, how we're going to do over the period of time, the balance sheet once again being where we will be at the end of a specific time period, either a month or a year generally. And we will also have the budgeted statement of cash flows. Thank you.